amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second win.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with a steward's view. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is A Steward's View. So glad you joined us again. Remember to visit this and previous episodes online at astewardsview.com or on your favorite podcast platform. Now let's take a look at what happened last week. The S&P 500 and NASDAQ composite indices ascended to new weekly all-time highs, rising 3.4 and 4.3% respectively, and completing a remarkable comeback from the spring's tariff-induced turmoil. The Russell 2000 index and international stocks also rose around 3%, boosted by prospects of lower interest rates. 8 of 11 S&P 500 sectors finished positive, led by strong gains in technology and communications. Financials rose 3% after the Federal Reserve voted to begin enacting steps to relax leverage rules for banks. Crude oil tumbled 12% to $65.14 per barrel as the lack of significant supply disruptions from the Israel-Iran conflict caused the risk premium to collapse. Gold futures also fell despite the continued slide of the U.S. dollar, which sank to its lowest level in more than 3 years. Increased expectations for interest rate cuts are pressuring the greenback, along with concerns about the Federal Reserve's independence. U.S. Treasury yields slid to two-month lows, with the 10-year note falling 10 basis points, that's 0.1%, to 4.28%. In congressional testimony, Fed Chair Powell said he does not foresee a rate cut in July, as two of his colleagues have recently suggested, preferring instead to wait for June and July's inflation readings for any signs of tariff-related price increases. Turning to economic data, the core PCE price index increased only slightly in May, inching up to 2.7% year over year. Signs of a slowing in consumer spending emerged, dropping 0.1% last month. Additionally, the final readout of Q1 GDP was revised lower to negative 0.5% from negative 0.2% after a sharp downgrade to the consumer spending component. U.S. business activity slowly and marginally decreased in June. According to the latest S&P Global Flash PMI report, the composite index fell, suggesting a potential inflation acceleration later this year. U.S. consumer confidence fell unexpectedly this month, reflecting concerns about the job market and overall economic conditions. The housing market remained hampered by both high home prices and mortgage rates. In May, the median home price for an existing home sold was $422,800, even with a big jump in supply. Meanwhile, new home sales fell by the most in 3 years as builder inventories rose due to higher material costs and a slowing labor market. Overseas, the NATO summit in the Netherlands ended with positive outcomes. The U.S. committed to the fundamental principle of collective defense, while other nations backed a larger financial commitment. Business activity in Germany returned to growth in June, with new manufacturing orders increasing by the most in 3 years. Sentiment surveys for businesses and consumers showed an uptick in optimism for the German economy. Australia's monthly inflation gauge cooled in May, opening the door to a potential rate cut as soon as next month. Finally, core CPI in Japan's capital slowed in June, but rising food prices will likely keep expectations for rate hikes alive. So another huge week. Let's talk about our content for this week. We're going to take a step back and maybe aside from where we've been. In past weeks, we've talked through a number of topics surrounding total return investing. We've talked about what it is. We've talked about how it's unique, why it's important, how to consider the tax treatment of it. And last 2 weeks, we've talked about asset aggregation. And then finally, we got into what consistency investing really is. And we stopped short of going in depth about consistency investing, which I intend to do in this program, remember this program is designed to serve investors with $1 million or more of investable capital. Okay, so there's value in these technical conversations for those who want to enhance what they're doing, right? Their decision making, yes, that's the number one thing. But with that comes a series of tactical considerations that we're trying to lay out for anyone who wants to consider ways to, as I describe it, tighten the range of returns around the same average or around a similar average. Okay, and that average is doing what? It's funding goals, and it is lining up with investor expectations and risk profiles. All right, so we'll get there, but there was a couple points in the last session that I thought were worth unpacking first, and it has everything to do with fees. Okay, so in this particular segment, I want to talk about fees. I want to talk about the different types of fees. I want to talk about the professionals involved, the measurement of them, the evaluation of them, and the comparison of them. Okay, so I wrote a book called The Life Cycle of Wealth. You can find it at fideradvice.com/life cycle. That's Fidere Advice, FIDERE advice.com/life cycle. In that book, there's a chapter called Finding Your Fiduciary. And in that chapter, I go through what I consider to be the 5 different types of financial offices. Okay. And Chaz is holding up the book. He's got like the last printed copy. It's coming back out in August. So he's knee deep in. Did you find the chapter yet, Chaz? Yeah. Okay.
I'm pulling it up right now. I thought I'd follow along.
All right. Excellent.
This is chapter 11 on page 74.
Chapter 11. There it is. So there are 5 kinds of financial offices in my view. Okay. And without going into what each of the 5 is, they all bill differently. Okay. They all are paid differently, if you will. And so most of what happens now, particularly for the audience that we're serving here, is either a wrap or an advisory fee. Okay. And so I'll start with that type of fee, right? It's a fee on assets. Okay. Very familiar concept to most investors. And a wrap fee is really just a fee in lieu of commission. Okay. And in technical terms, you're dealing with a brokerage office. Okay. Somebody that's carrying the series licenses, FINRA licenses, brokerage licenses. Okay. They're typically not highly designated. That's fine. They can do a great job of managing portfolios, and they've got somebody around in the ivory tower that can do the ultra technical stuff, so they don't have to. All right. So that wrap fee is a fee in lieu of commissions. Okay. Now, an advisory fee is also a fee on assets. It behaves in identical ways to the wrap fee. It's billed in typically quarters over the course of a year as a percentage of assets, around 1%. There's been some fee compression, so it can go slightly below that depending on the asset base. But the advisory fee is really just that. It's a fee for advice, and that advice is given as a fee on, in exchange for a fee on assets. Okay, so a very slight distinction there, but one has a history in kind of a basis in commissions, right? And one doesn't. Okay, they both are flat fees. One is a fee in lieu of commission. One is a fee just all by itself. All right. So whether you're in a wrap program or an advisory fee situation, you're looking at a flat fee. Okay. There's a flat fee for advice that you could get. My firm does that as well, where we're not necessarily managing assets. We're doing hourly work or some kind of a package retainer for a project. Okay. And that's, akin to what a legal office might charge for their time. Okay. On an hour-to-hour basis. There's a performance fee that's typically charged by a fund manager, or could be a hedge fund, could be a portfolio manager that is dealing directly with portfolios like me. Okay, now my firm and I do not charge a performance fee, but if we had certain benchmarks we were trying to hit in terms of returns, and then we would keep an extra fee above that return, that would be a performance fee. Okay, and that's typically in addition to advisory or wrap fees. Okay. So the project fee is kind of unique in this analysis because it doesn't depend on assets. All right, the flat fee. Flat fee financial planning, by the way, is very common in financial planning offices like mine. So There's all these fees I just mentioned that are disclosed or visible is a great word to the investor, okay, or to the end user, and so they're not that hard to figure out. You ask about it up front. Here's disclosure. You sign a contract. You see it come out. Okay. There are also what I'll call underlying fees for management teams. Now, management teams is a loose term that I use for mutual fund managers, exchange traded funds, some of their managers, separate account managers. Okay, so anytime you have management going on that is indirect, right? So if I say, well, my firm is going to charge an advisory fee on assets, we're going to advise these assets, we're going to allocate, we're going to optimize. I can't manage 15 asset classes all over the world. I'd need a building full of people to do that. All right. So I need to find help. And the help that I find is from what I call underlying management teams. And I'm typically using mutual funds because I can find the largest supply of management teams in the areas of the world I want to be in. But they have a cost too, right? And that cost doesn't come out on your statement. It's not always in your performance reports, okay? But it's a soft cost, if you will. So it's coming out, think of it this way, 1/365th of the year each day. And that's in addition to what? In addition to the advisory fee or the wrap fee or whatever your fee structure is with the person or people you're working with. So this can get expensive, can't it? It can get to, I think a fair expectation yet in the industry is about 2%, right? You have a 1% advisory fee on assets or wrap fee, and you have the underlying costs of management. Now, the active versus passive, the fund versus ETF, the cutting costs, let's go to Vanguard and do everything for 0.25%. That's fine. Just know what it is. That's the purpose of this conversation, is to know what you're paying. Okay. And my encouragement is that. So we'll talk more about passive investing, index investing in future weeks. I've hinted at that before. It's a very important conversation. But for now, I just want to encourage our listeners to know what they're paying and understand that there may be multiple levels, at least one of which is not clear as time goes on. So maybe, Chaz, as I look at this, we'll talk after the break about how to calculate some of this, how to evaluate some of this, and how to compare some of this. Okay, I'll leave open the possibility of getting into index or passive investing and the inexpensive nature of that and why it's so attractive. So with that, let's take a break and we'll be right back. In the middle of A Steward's View, I'm so glad we could add Dan Rushline. He is coming to us from Isle, Minnesota. Is that right, Dan?
I'm actually in Princeton right now, but Rural Music Ministries is definitely based out of Isle, so you're half right there.
Okay, you're in Princeton, and you're here to talk about Rural Music Festival, which I've told you is near and dear to my heart. It's an experience I've had now for 3 years since you started this, and it's coming up on its 4th year here this August. So what I was hoping you could do is explain a little bit about what Rural Music Festival is, how it started, where it's at, and where you think it may be going.
Yeah. So late 2021, I met Tim in a recovery group, and I had kind of mentioned to him that I had been having a dream about throwing a Christian music festival in central Minnesota. It's something that had been recurring for me for a long time. The light bulb went on in Tim's eyes, and it was really a confirmation from a calling that he had been receiving as well. Him and Cindy were already kind of in the works of planning a small concert, Christian concert in the back of their resort on the lawn out there. And so when I told him festival, I don't necessarily think he was convinced that was a great idea because it is a pretty big undertaking. But Tim is a man of faith, and he really encouraged me to run with it, and he jumped right on board. I jumped on his board really, but kind of pushed him into making it a little bit bigger than what he was initially planning on. So
So a little bit about how this started. I mean, you had a dream, and you shared this with a friend of yours there in that area in northern Minnesota, and his name is Tim, and his wife and he were working on something to have some music come in. Big national Christian act, I think you said Big Daddy Weave originally.
The initial goal was to get Big Daddy Weave. Yep, that's correct.
And they didn't come because there was a death. One of the band members, or the lead band singer, lost his brother. Okay.
That's correct. Yep, it was right towards the end of COVID, and so the cool news is that this year, the end of July here, I think on the 27th, Big Daddy Weave, Ben Fuller, and Megan Wood will all be playing. Not at the festival itself, but at a tour stop at Redemption Hill, which is our venue. So we are charging a little bit for that. We're using it as a fundraiser for the event. So
let's explain Redemption Hill to our listeners. This is where World Music Festival takes place. This is where 12 to 15 bands is, what's the number now coming this year?
We have, I believe there's 15 on the docket. We're shooting for one more. We're kind of waiting on one last offer that we have out there, but right now it looks like 15. So
great. And so this festival came about early on with the idea of kind of a backyard national act coming in, and has grown to now where you have nearly 15 acts, and that original act that didn't come showing up for a separate concert. All at Redemption Hill, just outside of Isle, Minnesota. Yes?
Yep, that's correct. Yep. Okay. So Redemption Hill was actually, when we realized we were having a festival, we realized we needed some more space. Redemption Hill actually used to be called Smokin' Hill. It was a VFW at one point, and then it turned into a bar. And after that, it kind of became I don't know if you would call it the drug haven of kind of Mille Lacs County. And so when that almost came up for sale at the same time as this calling was placed on our lives. And it was really kind of predetermined that we were supposed to go after and get that property. And so we bought that property, and we're in that it's not an active establishment anymore. The only thing it's used for is the festival itself. So, but we're redeeming the ground, that's for sure.
Wow. And what a blessing. What else would you like our listeners to know about this event? I mean, I've heard it's donation only. I've heard there's been some amazing things that have happened with that. What else?
Yeah, the whole call for this event was to make it accessible to everybody. So whether you're a Christian or not, we wanted everyone to feel welcome, to feel like they could get in the door without really having to put any skin in the game whatsoever. So really the whole message is bring everybody you know. Come on up for a weekend. Enjoy 15 national recording artists. Where else can you do that? We have camping on site. You never know. The Holy Spirit might just show up in someone's life who you never expected, and we've absolutely seen that. Last year on Saturday, we did over 60 baptisms and discipled over 60 people. So we're hoping that, I mean, God is going to move however God chooses to move, but we're hoping that number continues to grow. And that's the whole point of the event, is to introduce people to Jesus, show them grace, love, mercy, model for them what the Christian community and neighborhood is actually like. So we just want to get everybody up there. That's the whole point of the whole thing. So
60 people.
Probably more. We're thinking thousands of people probably have either recommitted or committed their lives for the first time. Last year we had over 18,000 people over the course of the 3 days. So it's gotten a lot bigger than we anticipated at the beginning.
Sure.
We had about 18,000 people last year. That first year we were right between 5 and 6 over the course of. Remember, the first year we were crazy enough to do it for 4 days. So we've since scaled that back to 3. 4 is a little bit too much. For the volunteers and the sake of everyone who's trying to make sure that the logistics of the thing keep functioning, 4 days is too much time. So,
well, it's a remarkable event. And where can everybody go to learn more about it?
Yeah, ruralmusic.org. So rural music, RURAL music.org. Check us out online. We'd love to see you come and spend your weekend with us. If you're interested in volunteering, we're always looking for help. If none of those things pique your interest, prayer. We need a lot of prayer.
Dan, this has been so delightful to have you on the program. Thank you for joining us. We've been talking with Dan Rushline. from Rural Music Festival, one of the founders of that event. It's now a national event, and I'm going to say that because I've attended all 3 years, and I've seen people from all over the country come to this. And so that's coming up. The dates again, Dan?
Oh, man. August 22nd through August 24th.
Okay. So check it out, ruralmusic.org. Dan Rushline, thank you.
Thanks so much. Appreciate your input.
You bet. And we're back. Okay, so let's go to an example of what we talked about in the first segment, which was the layers of fees and the types of fees that could be charged. I referenced the book, The Life Cycle of Wealth, that you can pick up online and that will be available for sale all over the place and on our primary website, astewardsview.com, come this August. But my comment isn't just about the book. It's about the different types of professionals that you can engage in the different ways that they're paid. We didn't talk about being paid as a percentage of a balance sheet. That's also a possibility, by the way. Typically a family office scenario where the net worth is calculated for the family or families being served, and a very low percentage of that net worth is charged, but it ends up being a significant dollar amount every year that goes to operations of either a family office style arrangement or an actual family office where the family owns the professional office that is serving it. Okay. So knowing what kind of office you're in, how you're paying, what you're paying, evaluating that, just a matter of doing your homework. When you go to compare the kinds of fees and the total fees, it's good to know what they are, as we have said. The second thing, though, is to know what you kept, and that's the big one, right? So, what did you keep? Historically speaking, composites are great. I get asked this question all the time: are you running composites? My answer is not yet. So, our models are haven't had a need to run composites the way we serve, but at some point we'll get to that as we grow. My comment for this purpose is to say, okay, just know whether or not you're looking at a composite. And what is a composite? It's a historical tracking, an actual tracking of transactions done. You could look for GIPS compliance, okay, and figure out whether or not what you're looking at is actual versus an example or hypothetical, okay? And I use examples all the time because, frankly, in my practice, there's so much difference in when people come and go from what they're doing, in the customization that happens. It is very almost fruitless to go to all the work of building composites. But having said that, my answer is not yet. Just know whether you're looking at a composite or not. So when you look back and you say, here's the example. My moderate portfolio generated 8% over the past 5 years. Okay, and I'm picking a number. Sorry, Chaz, it's not the 10 you like to pick. But it picked, I'm picking 8%. So I kept that if I have an after fee number in that 8. Okay. If it wasn't, if that's a before fee number, what was the fee? We can do the math. It's not an exact reduction. You don't say, well, I generated 10, I paid 2, therefore I kept 8. That's not time and dollar weighted. We have to do some more advanced math, but it's close. So for the purposes today, we'll say, all right, well, if the 8 is what you kept and you paid 2, great. Now you know what stayed in your pocket in this example. All right, well, what was the risk score? We talked about that in the last week or two. The risk associated, how much was that? Okay, so what was the range of returns expected or what were possible? So let's use that. Let's say, all right, you kept 8%, you paid 2. What if the person that kept 8% only paid 1 or 0.75%? Their net is the same. Chaz, would you know the difference if you opened your statement and it said, somehow your statement said this? Maybe it's a 401k plan. They do this a lot. You kept 8% in a given period backward year over year. How would you see that if you opened it up? Would you go, my underlying fees were X, or would you say, no, I kept 8%?
No, I kept 8%.
Okay. So do you care what your fees are?
Oh, well, of course I do. Yeah. If I start seeing significant changes, I'm going to be like, hey, this is not what I expect.
Okay. So what if we change the game now and we say, okay, well, you kept 9%, you paid 2, you knew what your fees were, you did your homework, you paid 2% to get the 9. All right. Well, what about the person next to you that's opening their statement? You're having coffee now, and they say, well, I kept 8 and I paid 1% to get the 8, but man, look at my low fee.
Right.
Okay. How do you see that?
Well, it definitely speaks to me. It's attention getting, but I'm just kind of shooting off the cuff. I need to look at these things in front of me, Aaron, not just in the air, like you're talking about.
You need to have some more coffee. All right, got it. So understood. But the comment is hopefully obvious, and that is, and I'll be clear here. I mean, you typically pay for what you get, but if you have to pay a little something extra to get a little something extra, wouldn't you go ahead and do that? Okay. So I'm making a clear case here for not getting hung up on fees, for knowing what they are, accounting for them, but then looking at what you kept. Okay. Now, I had a meeting recently with a long-term client who I've just had a great relationship with. And, his net return wasn't quite as I would like to see it. Okay. So he was close, but not quite in line with market averages. Okay. And we had to look at the why, and we went into that. Now, when I looked at his risk scores, by the way, the fee structure there was about like we just described. Okay. So he's closer to, I think, 2% in total cost to get this global allocation. He's got, 28 management teams working for him. And it's been a very consistent pattern for him. So that's encouraging. In fact, his goals are totally funded. He's 46 years old. And if he's listening, then he'll, hopefully appreciate this. So my comment, though, is that when we looked at the risk profile of that portfolio, that risk score, the standard deviation, and the Sharpe ratio, if we remember what that is, we found out that on the recent 3 years, his Sharpe ratio was actually better, even though really returns were right in line on the 3-year and the 5-year. He was lagging a little bit. Okay. But the Sharpe ratio was about the same on the 5-year, even though returns were lagging. And on the 3-year, he was ahead on Sharpe ratio. Okay. So remember, we now jumped from underlying fees, acknowledging, accounting, like knowing what they are, and then looking at what you kept, and then adding this conversation about risk scoring or consistency investing. Okay. Why? Because if the returns are all equal, fees may not be, but the net kept is equal between you and your friend Chaz at coffee at 8%. But your risk score is lower by 10, 15, 20%. You can very well expect that your same average 8% or 10, as you like to pick, pick 20 if you want, but that same return is going to more efficiently fund your goals. Okay. And it matters most when we're in that 1 year out of 5, historically speaking, where we've got a down market. Okay. By market, I mean stock market. Okay. Which stock market? Lots of them. But we use the S&P 500 in the U.S. to track. And it's about a quarter of the world's market cap. Okay. So what I'm trying to get to here is that we need to know what the fee is. We need to calculate, look at the after fee result compared to whatever else you want to compare it to, and then consider the risk taken by the investor over the same time period. Okay. So if you can get a better Sharpe ratio after fees, on a rolling basis, I mean, a multi-year, this is not multi-quarter. This is not the statement opening, frankly, where you look at, how did I do in the last 3 months? If you can even get that. Most places you can't. You can get the data, but you can't get these scores. So if you look at a multi-year basis, rolling net after fee, which fee? All fees. I always talk about, what is it? Every single dollar you paid, set aside, netting out what you kept, that's the key, and then adding the risk score to it, looking at the Sharpe ratio, making sure that you're doing what? That you're getting a tight range of returns. Why? Because the next bear market, we're going to need to know that we've got some cushioning on the downside and that we can come back faster. Back to what? Back to our average. So I hope this has been a help. Chaz, I didn't give you as much opportunity as I wanted to engage with this, but there's so much here with fees. I want to just warn our listeners not to get hung up on just what the fee is. Okay, so it's important to know, it's important to compare. It's important to know where you're, who you're working with, what it costs, all that. Be a good consumer, please. This is a lot of money, typically. I mean, we're talking 7-figure asset bases here. So for sure, have those conversations, but then let it be. Don't come back and say, oh, well, I don't really know if I'm happy with this or if I can get a better deal somewhere else. Maybe you can, but what's the net after fee result that other place is offering or has accomplished? I'll say it that way. And then what's the risk score associated? So there's a lot more than just what's the fee. Unfortunately, in 2025 America, with all the digital chaos we get and the advertising we hear, it becomes often just that fee number. So I'll leave it there, but I hope this has been a benefit. Chaz, anything else you want to add to your 10% brain there?
Yeah, brother, I was going to say, I think that, and I won't be embarrassed if you have to correct me, Aaron. As I'm hearing you talk and think through all these fee structures and things, it's like you might spend more in a fee, but hopefully your rate of return and your risk obviously is going down. So, with your simple example of a couple percent for 8 or 1 for 9, it's, again, my brain needs to see that in front of me. But if your fee is higher, hopefully your rate of return and your rate of return is higher and your risk is lower.
Amen. Well said. Yeah. Thanks. Wow. Maybe we should have just kept it there. Just had you do all this.
Whew, I was sweating it, buddy. I was sweating it.
We could have it done in like 2 minutes.
You got to give to get. How about that?
Could have been having that extra cup of coffee you needed.
There it is.
Thank you so much. Well, before we wrap, let's zoom out and take a look at what's coming up this week. U.S. markets will shutter early on Thursday and be closed on Friday for the Independence Day holiday. The shortened week's economic calendar features the monthly U.S. jobs data, with differences of opinion starting to emerge among FOMC members on the timing of rate cuts and pressure on the Fed building from the White House. This employment report may hold more weight compared to recent months. The Atlanta Fed GDP Now model is currently estimating Q2 growth of 2.9%, but economists caution that the large gyrations in import data may mask underlying softening activity that has shown up in recent housing, labor, and consumer spending data. Thursday's non-farm payrolls for June are expected to be around 120,000 added jobs, with the unemployment rate ticking up to 4.3%. ADP private payrolls, JOLTS job openings, and Challenger job cuts figures will arrive earlier in the week. Elsewhere, Fed Chair Powell and other central banks heads are scheduled to participate in a panel session on Tuesday at the European Central Bank Forum in Portugal. The rest of the domestic economic calendar includes ISM manufacturing and services PMIs, along with factory orders. On the international side, the Eurozone's preliminary CPI for June will be released early this week and is expected to remain at or near the central bank's 2% annual target. China's manufacturing and services PMIs and Japan's Tankan indices are the other releases of note. With that, it's been such a pleasure to be back with you. I do hope this session has been a benefit to you and to others you decide to share it with. We invite you to connect with us online at astewardsview.com. You can also schedule with our sponsor, Fadir Advisors, in the footer of that website. That's astewardsview.com. From all of us at A Steward's View, we look forward to connecting with you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.